How's it, Gr10? So today we are starting with a brand new topic called financial accounting of a sole trader. Now remember, what is a sole trader? A sole trader will be a one-man show, a one-owner business. We can also call it a sole proprietor. So that is when we have one person running the business and he's normally the owner of that business. But let's go and look at the overview of what we are doing today. We will look at the GAAP principles today. We're going to look at the ethical thing to do when you compile your accounting records. We're going to look at the internal control. So internal control, how do you control your assets and especially your trading stock and money within a sole trader. We're going to look at the bookkeeping of the sole trader today, and we're going to look at the accounting equation. So let's start with the terminology you need to know. What terminology? So I'm going to give you about 3 minutes to go through these phrases and hopefully you get all the correct answers to them. Firstly, what is a transaction? So explain a transaction to your friend next door. Again then, the GAAP principles. Can you still name the 6 GAAP principles we've done? See if you can name all 6 and maybe explain one to a friend. Then, give me a few source documents. What source documents do we have? And then, very easy, distinguish between receipts and payments. So your 3 minutes starts now. Okay guys, I hope you got all 5 of these questions correct. Let's go and look at the very first one, transaction. Now, what is a transaction? Now, firstly, know that it's a negotiation. It's normally negotiation between two parties, and I'll give you an example. It's when you walk into the shop, you take a product off the shelf, you go to the cashier, you exchange money for the product, and then you leave. So therefore, that's a transaction. Another transaction can be you walk into maybe a clothing store, you take a nice shirt off the shelf, you swipe the account card. So you're buying it on account. So there's again a transaction taking place between you and a second party. So that's more or less a transaction. Let's go and look at the GAAP principles. What 6 GAAP principles do we have? The very first one will be your historical cost. Now remember, what does historical cost mean? Historical cost means whatever I buy, especially vehicles and equipment, that's your cost price. If I pay 2,000 Rand for a cell phone, what did you pay now? And yes, it will be 2,000. What would you have paid in 3 years? Again, maybe 2,000. That's what you've paid. And I'm just going to quickly name the other 5 because we're going to look at all of them in detail. We have the matching principle, we have the principle of materiality, we have the prudence principle, the going concern, and the business entity. So that's more or less what I wanted. You had to name all 6, but explain one to a friend. Now let's go and look at the source documents. Now remember, a source document is the first place something will be recorded after a transaction took place. Now to give you examples, we have a duplicate receipt. Remember, your client came into the shop, we torn off the original receipt out of the book, we keep the duplicate. Also, a check counterfoil will be a source document, or a bank statement, an invoice. All of those are first points of recording a transaction. So that we'll have millions of these documents, and then we will sift through the information and make it easier and more readable to those who need it. Another one, the receipt. What is a receipt? Now, the receipt is issued to someone who gave the business money. Now remember, put yourself in the business shoes. You are the business when you work in accounting. So if you need to receive money, so you are the business, you can receive in various ways. You can receive capital from the owner. Remember, you are the business, you receive money from the owner, so therefore you receive money. You can sell items. So if you sell items to your customers, you'll receive money. Another way you can receive money is when your debtor comes into the shop, or even if he does the EFT online, the business will receive money. Let's look at one more, a donation. If someone sees that you're a young entrepreneur, maybe a family friend can give you a small donation to start off your sole proprietorship. Now let's look at the last one, payments. A payment is again a type of transaction that takes place. What type of a transaction? When the business, you the business, need to pay. Now you can pay for various reasons again. You can pay your water and electricity bill. You can pay a telephone bill. Remember, all businesses will have people working within them, so you'll have to pay wages. Remember, wages will be your weekly payment. You can pay salaries monthly. Insurance and advertising can also be payments. You can pay your creditor, or you can buy certain things. So you can buy trading stock or equipment or even vehicles. So that was your answer. Now let's continue with today's lesson. Now, very important, terminology. And for these 6, I'm adamant, you need to know them. You need to go and study them. You need to know what will be included under each of these headings. Now, I'm going to quickly ask you to go through them with me, but then I want you to write down a few examples of each. So let's look at them. Firstly, what does the word assets mean? What does liabilities mean? What does owner's equity mean within a sole trader? Capital? What does income mean? And lastly, expenses and drawings. So I'm going to give you 2 minutes to quickly look at them and give me an example of each. Okay, guys, I hope you got all the answers. Remember, we covered this in great detail in grade 8 and 9. So let's go and look at the answers. Assets are items the business or sole trader will own. Remember, these are belongings to the business. Now, we have two broad categories. I'm quickly going to explain it. We have the non-current and the current assets. Now, what is non-current? Non-current means I'm going to use these things for longer than a year, like your land and buildings, your vehicles, your equipment. Maybe if the business will have an investment, they will use it or invest for longer than a year. Then we get to current assets. What current assets do we get? Now you need to know that current assets are within a year. We are going to hopefully sell all our trading stock within a year. I don't want to keep milk in my business for longer than a year, so hopefully you will be able to sell it within a year. So your inventory or trading stock will be a current asset. Your debtors control, you're not going to wait for 10 years for them to come and pay you. You have to get that money as soon as possible. So if you sell on credit within maybe a month or two, you need your money. As you can see, it's shorter than 12 months. And then your cash on hand. And remember, we'll keep cash in your bank accounts. Petty cash, remember petty cash for small payments, and then cash flow, change in the till. Those are all parts of your assets. Now let's look at liabilities. That's complete the opposite of assets. Liabilities are stuff that I owe. So I, the business, owe different individuals, maybe institutions, other companies, but again, we'll split them in two. We'll have your non-current liabilities and your current liabilities. Very important to distinguish again. Non-current, longer than 12 months, so more than a year. We'll have them more than a year. And then your current, shorter than 12 months. We need to pay these liabilities in maybe a month or 2 or 3, up to 12 months. So let's look at examples. Your non-current liabilities will be things like a mortgage loan. When you bought property, you go to the bank, you ask for a nice loan, and they will give you a mortgage loan. A current liability, example, creditors control, when you buy on credit, or when you went into a bank overdraft. Remember, you can go and ask the bank for overdraft facility, and then you can use it. But then if you use it, it will be a liability, so therefore you will owe the bank. Until you've paid, it will be a liability. Now, I have owner's equity. Owner's equity is everything connected to the owner. Remember, you as one-man show, you as a sole trader, you are going into business to make a profit. So that's your very first aim. But remember, we need to put in money. And what do we call that money? Let's go and see. Owner's equity will be firstly capital. So that's our very first type of an account, your capital. And remember, capital will be anything the owner gives. It can be a vehicle, can be equipment, it can be cash. So any of those forms will be regarded as capital when the business receives it from the owner. But let's continue now. Remember, all businesses will need income. So income is needed. Now, remember, income is the way and the source of generating money. So we'll have sales, we have current income for rendering services, we'll have interest income. So there's quite a few incomes we'll deal with during the year. And then lastly, expenses and drawings. And I'm putting them together today. Remember, when the owner takes money, it's regarded as a drawing. So always keep the owner's transaction separate, but then we'll have expenses. Remember, businesses need certain things to operate. So we'll have to pay rent. We'll have a telephone account. We need to pay water, electricity, our salary earners, our wage earners. We need all of these things within a business to generate that income. And hopefully your income will be more than your expenses. And that's when your business is making a profit. So I'll see you now after the break. Okay, guys, so now that we've looked at all your different type of an accounts within a sole trader, we're going to now quickly look at why a sole trader? Why are we going to look at a business that is owned by an individual, one person? Why will one person want to own a business? Won't he need help? Will he have enough cash? And then I want to look at your two broad categories of businesses in South Africa, your formal businesses and then also your informal businesses. So let's quickly look at the breakdown. So remember, we have two broad categories. We have formal businesses and informal businesses. So I want to quickly look at informal businesses. We can have a sole trader, remember that is one owner, or we can have a partnership under these informal businesses where we have 2 to maybe a maximum of 20 owners within a business. Now, what makes it an informal business? Or let's quickly rephrase that question. What is an informal business? An informal business will be a business that's not registered for maybe VAT or registered at SARS. And these businesses normally operate on a cash-only way. So they only receive cash and they only pay cash. There's no credit transactions within these businesses unless the vendor or the hawker knows who they're selling to. So I already gave you a few examples. Let's look at a few examples of your informal businesses. We'll have hawkers, street vendors, people that sell at flea markets. We can have a lady or a person that bakes cakes and sells it at schools or at workplaces. So those are all informal businesses. Even your tutor at home, when someone helps you with your extra accounting at home, that will be a tutor, and that will also be regarded as an informal business. Maybe they're not recording all the transactions. Now, these businesses don't need a lot of cash. Okay, so capital is limited. We don't need a lot of capital. The transactions are not always recorded in a formal manner, a formal accounting manner. They don't have a lot of equipment, maybe just a table and a chair, maybe a gas stove. So as you can see, they're very primitive, but how do we know that they are making money? And at the end of every day, these business owners will see, do I have enough cash left over to go home? Do I have stock left over? And with that, they can easily tell if they made a profit for the day. But now, let's go back to your sole trader in a formal way. The formal businesses, let's look at them. Firstly, in grade 10, we're going to look at the sole trader. Now remember, sole trader again, one owner. Then we'll have partnerships within our curriculum. Now partnerships, grade 10s, will be covered in grade 11. We're going to look at that in grade 11 in full, but know that we are starting off with the sole trader, and next we will look at partnerships. And then in grade 12, we will look at companies. Now, companies again, grade 12 work, not very important now, but no, there's more or less a format that we're going to cover. We're going to cover most of the stuff in grade 10. We're going to build on the stuff that we're going to do in grade 10 in grade 11, and then again build on the grade 10 and 11 work in grade 12. So very, very important. We need a strong foundation. The stronger your foundation on the sole trader work, the easier you'll find the work in grade 11 and 12. But let's quickly continue with your type of businesses. Now, firstly, we can have trading businesses. Now, what is a trading business? Guys, trading, what happens when I buy and sell? And as you can see, formal businesses and informal businesses can buy and sell. So, very important to know, when I sell something, I will have a cost of sale. And we will look at the formulas to work out cost of sales and your profits, all those things in lessons that we'll do in future. Let's look at another one, your service businesses. Now, what is a service business? That's when you go to someone and you don't always take something back home. So you go to a spa or beauty salon, or you go to the dentist, and a tutor and a teacher. Those are all service renderers. So we render services, but you are gaining something, but it's You can't really touch it. Let's look at the last one, manufacturing businesses. So that's number 3. And we are going to look at manufacturing in grade 10, 11, and 12. So in grade 10, we'll look at what is manufacturing. Remember, that's making a product. You easily walk into a shop and just take it for granted. But where did that product come from? And then your informal business and formal business can use this. Remember, someone carving nice ornaments out of wood will be maybe an informal trader selling at a flea market. But then you have these massive production facilities, manufacturing cars and mass clothing. That will all be manufacturing businesses. Now, I have a good question for you. Why do we need accounting / bookkeeping? I'm going to quickly give you a minute to explain that to your friend next door. Good. So let's see if you got it right. Why do we need accounting, or why do we need to keep your records safe? Why do we need to do the bookkeeping of a business? Now, think of this. Every day in just a small shop, how many transactions take place? So, how will you know if this business is doing well, making good profit? How will you be able to tell how many assets we have and how many assets we've accumulated over the existence of this business? So accounting is a very, very important thing within any business. If we record every single transaction, we'll easily see this business is a success, making a profit, or should we change our spending habits? Are we spending too much on expenses? So it's also a way to keep track of where we're heading and what we want of our goals. So how do informal businesses keep records? And that's not in a formal way. Maybe they do keep records in a formal way, but remember, when you're sitting on the street, the wind is blowing a bit, you receive money, you need to sell, you need to package the things. How do those street vendors record the transactions? They might record it just on a piece of paper to say, I received 2 Rand and 10 Rand and 20 Rand. And then at the end of the day, they see, did they make a profit or loss? Hopefully they sold all their items and they don't need to carry anything home with them except their tablecloth, maybe their chair. But if they didn't make enough money to buy new stock for the next day, what then? And that's the reason most businesses, especially the formal businesses, keep accounting records. Now, I want to leave this question with you for a minute. What is ethical in a business? Okay, guys, so ethical. What does the word ethical mean? Let's write it down. Firstly, it's to be truthful. Or to be honest. Or to do the right thing. Now, to explain it in a business context, remember, we need to record all these transactions. We are working with stock, we are sometimes working with cash, and what do we want our staff and our customers to do? We want them to be truthful, honest, and do the right thing. So, whenever something happens, we want them to record it in an honest manner, to be transparent. What does transparent mean? Not to hide anything, and to be 100% truthful. So I'll give you an example. Say you go to your tuck shop and you're buying a pie, and the lady at the tuck shop promises you that this is a nice meat pie. But in 2 months, you found that this is not real meat, this is soya. Will you be happy? Definitely not. So therefore, what will happen to a customer base? Will you still go to that business and buy from that business if they weren't honest? Do you understand? So it's a two-way thing. It's a two-way direction. So if you record your stuff within a business, you need to be ethical, you need to do the right thing, do it honestly, but also when you sell to your customers, you need to be truthful. You need to tell them exactly what's in that product. What does it consist of? And with that, hopefully, the client will return if they are happy with what they've bought. So, how does one control and keep the assets safe within a business? And that's quite easy. I'm going to start you off slowly. This is internal control. We need to control our assets within the business. Why do we need to control our assets in the business? It's very important to keep our equipment safe, our vehicles safe, and our trading stock safe. Now, those are all three tangible. So we can have maybe a storeroom to lock away all our trading stock. We can have a logbook for our drivers to fill in, or maybe a tracking device to see how they are driving with our vehicles. But then as well, cash. Remember, cash is the easy one that can disappear within a business. Now, how do I keep my cash safe? I need to put systems and procedures in place so that not only one single person works with all the finances within a business, but that it is shared between two or three, and we call that DoD. What does DoD mean? I will call it division of duties. Now, guys, I'm leaving you now. I'll see you in a bit. Okay, guys, let's look at a question. I'm going to give you 3 minutes to answer these questions. Define the following terms: informal businesses, trading businesses, and service enterprises. And please include an example in each. Okay, guys, I know you got all three of them correct. So let's take the first one, your informal business. Now remember, your informal business will be a business. It's normally small. They have few assets. They are not registered. And they're normally a sole trader. Now let's look at an example. Can be a hawker or a street vendor. Hope you got that one right. Let's look at the next one. Your trading business. Now that's quite easy. That is a business that buys goods and then sells them. But very important, they sell it at a higher price. Now, an example can be a supermarket. Now, what is a service enterprise? A service enterprise will be a delivery of services. For an example, a salon or a spa. Now, guys, remember, even a restaurant can be seen as a service enterprise because you go to the restaurant. Yes, you are eating food. Maybe you leave with a doggy bag, but mostly, hopefully, you eat up all your food, so you leave with a full tummy. And therefore, you've received something, but you couldn't take it home. And they rendered that service of preparing the food for you to make your life nice and easy. So let's go on to the GAAP principles. Again, name the 6 GAAP principles. And I want you to now name all 6 within a minute. Let's see if you can do it. Okay, Gr10s, let's see. I'm going to quickly name them for you, but then we are going to explain each one in detail. Now let's start at the top. We'll have the historical cost. Then we'll have the prudence principle. Then we have the 2 M's. We have the materiality. We'll have the matching. We'll have the going concern. And then lastly, the business entity. So let's go and look at the first one. The very first one, historical cost. So let's read it quickly. Assets like land and buildings can appreciate in value over time. The historical cost concept states that when assets are bought, they should be recorded at their historical cost, which is the price originally paid for them. If they increase in value in later years, we can then make a provision for this change. But this won't happen in Gr10, guys. So, again, historical cost. Let's look at all 3 assets connected to the historical cost. Firstly, land and buildings. Remember, we did read that they will appreciate, but now I want to go in a bit more detail. Remember, when you drive that new car off the showroom floor, will it still be worth the same amount of money that you've paid for it in 2 years? And definitely not. So they will lose value. But in accounting, we need to remember that we need to record this vehicle at the historical, so the past tense, the historical cost price. So say we have paid 250,000 Rand for this vehicle. We need to keep this vehicle in our books under the ledger account vehicles at 250,000. That is the historical cost price. Although it's not worth 250,000 Rand in 2 years, we still need to include it in our books and keep it at that price. Another example, you're buying a brand new laptop. That laptop is costing 5,000 Rand today. Now I'm asking you, what did you pay? You've paid 5,000 Rand for it, right? So, will this laptop be worth 5,000 Rand in 3 years? And hopefully your answer will be, no, it won't. So, did this laptop lose value over the 3 years? And yes, it did lose value, but this principle shows us that we need to record the laptop at the historical cost price, which is 5,000. So even if it lost value, we still need to keep it at the historical cost. Very, very important. I trust you understand the historical cost price GAAP principle now. Let's continue to the second one. Let's go and read it. The prudence principle. Sometimes accountants are aware of events or circumstances that could affect the business, but because these events have not yet occurred and are not definite, they are uncertain of the exact outcome. The prudence states that in these circumstances, an accountant must report in the most, and that's the very important word there, conservative manner. If the financial statement showed a more favorable position of the business than was actually the case, and this we don't want, people that invest or buy could lose out financially. So hopefully you understand what we read. Now, to put it in plain words, you need to be very pessimistic when you record transactions, especially at the financial year end. So prudence states that you need to be conservative. You can't say, I think I'm going to make 20 million Rands worth of sales, but you did not. To put it in a better way, you received a nice check worth 10,000 Rand. You record it in your books, but now the check is missing. You lost the check. Now what I want to ask is, does the business still have the money? Can you keep this 10,000 Rand in the sole trader's books? And the answer is no. We've lost it. We don't have it anymore. So we can't say, hopefully we'll find this check. No, we need to take it out of the book. So we need to include a transaction to cancel this receipt. So therefore, you're being conservative or you're being pessimistic. Now let's say within 2 months, this check appears out of the blue. Can you record it again? Yes, you can record this check again if it's still valid. But remember, especially at the financial year end, all the things need to be taken into consideration on worst case. Let's look at the next one. The matching principle. Now guys, according to the basis, transactions are recorded in the income statement and balance sheet in the financial year when they happened and not when the cash, that's the important one, for the transaction is received or paid. In the same way, if an income amount has been received or an expense item has been paid, but it is not an income or an expense for the current financial year, it needs to be excluded. It must not be included in the income statement for the current year. So easily, I don't care about when I receive or when I pay. What do I care about? I care about when should this income or expense been taken place. Should it be taken place this year? If it should have happened this year, I need to put it in for this year. If it is not for this year, I need to take it out. And especially in the third term, Gr10s, we're going to use this principle all the time. But know that all income and expenses needs to be matched for a certain year. Let's go and look at GAAP principle 4. That will be your materiality. So materiality, let's quickly just get up a bit. Because people use accounting information to make decisions, the accountant must draw the business owner's attention to information that will be important to him or her. The materiality concept states that information that is important or material must be shown separately in the financial statements so that they are highlighted. Information that is not important or material can be added together and put into the sundry income or expenses. Now, what do we understand under this concept? Materiality. Is it material to show each and every single stationery item? We have an account for pencils, we have an account for pens, we have an account for paper, we have an account for receipt books, we have an account for ink for the printer. We have 10,000 accounts just showing in stationery. Or can I maybe put all of the stationery for sole trader under stationery? Or, even better, you're a very small business. You don't use a lot of stationery. You don't use a lot of packing material. You don't use a lot of consumables like your cleaning material, your coffees and teas. Can I include all of those under sundry expenses or consumable stores? And that's what materiality means. Should I show certain things separate? Is it material for the owner or not? Let's move on. Our fifth GAAP principle today will be your going concern. So let's mark it as number 5. The going concern assumption is that a person reading your statements of a business assumes that the business is intending to continue to operate in the foreseeable future and that the owner of a business is not intending to sell or close down. So his business sometimes in the future. If the opposite is true, the account should note it in the statement. So, the last bit, not too important, but the beginning. Let's quickly look at it again. Going concern, is the business continuing, going on in the next year, or will the business be sold or closed down? So remember, whenever we state or drop statements, especially in term 3, this will be again asked. What do you understand about going concern? Will the business go on? Will they continue? Or will the business close down? Now let's look at the very last one. We have the business entity. This concept says that accounting records of a business must be kept separate from the accounting records of the owner. So all owners of the business. This is so that it is possible to accurately work out the profit and loss of the business without confusing it with the owner's personal income or expenses. Now guys, remember the business entity will have an account called drawings. I don't care if the owner takes cash, if he pays his insurance through the business, if he gets school fees in the business, if he buys petrol, even if he takes 20 Rand out of petty cash. All of those items will be regarded as drawings. So therefore, what do I say? All drawings, everything that the owner takes throughout the year, even if he takes a packet of chips from the shelf, will be regarded as drawings. Even if he takes stationery home for his kids, will be regarded as drawings. It's for his personal use. So guys, remember, everything the owner takes will go to drawings, and whatever he takes will be decreased on the credit side of the account. We'll look at that in detail next week. So I trust that you'll be able to name all 6 GAAP principles, know all the types of businesses, and especially know what the sole trader is and know how to use the sole trader and how we're going to go about it to record all transactions connected to the sole trader in a formal accounting manner. Thanks for joining.